The following presentation is to address one of the major announcements of Budget 2020, abolition of DDT. Hi, I'm Shruthi Meenakshi, Chartered Accountant into practice, associated with the firm in Puducherry as partner. So now that the DDT has been abolished with effect from 1/4/2020, here are the topics I would like to view in the coming presentation. Why was DDT brought into effect in the first place? Through Finance Act 2003. Transitional provisions after 1/4/2020, intercorporate dividends, and the deduction available now post abolition of DDT under Chapter 6A under Section 80M, and the benefit of 115O, which was available with the DDT being in effect during the past years. Issues with DDT, and finally gainers versus losers after abolishing DDT, as in the list of people who will be paying less tax with DDT being abolished as versus the people who will be paying more taxes. Why was DDT brought into effect in the year 2003? Single point of taxation. Tax on dividend was levied at the time of distribution itself in the hands of companies and made exempt in the hands of shareholders. With abolition of DDT, tax on dividend income will now be taxed in the hands of shareholders or unit holders. That being now taxed in the hands of shareholders or unit holders will be in as per their slab rate, rather as opposed to the fixed rate of 20.56%. Now, the deduction of interest shall also be allowed against the dividend to an extent of 20% of the dividend. First, transitional provisions. The abolition of DDT comes into effect from 1/4/2020. Dividends declared on or before 31/3/2020 but received by the shareholders on or after 1/4/2020 shall be exempt in the hands of shareholders. That is, the conditions or along with the conditions which was prevailing till 31/3/2020. That is, the company has to pay DDT on such dividend income for the shareholder to avail exemption, and where dividend income exceeds rupees 10 lakhs, such excess will be taxed at the flat rate of 10% along with the surcharge and cess as applicable. The next point of consideration would be intercorporate dividends. Against the dividends received by a company from another company, foreign company, or business trust, dividend distribution shall be reduced if the same is done prior to 1 month of due date of filing returns under Section 139(1). Now, for this chapter or for this topic of intercorporate dividends, deduction under Chapter 6A, as mentioned before, is now available under Section 80M. Now, what are the considerations, or what will be the difference between 115O, which was available till 31/3/2020, and 80M, which is now currently available after abolition of DDT? Whether deduction is to be done, is to be claimed on gross or net dividend income. 1. Since this is a Chapter 6A deduction, the amount will be on the net dividend income. As suppose 151, even that was available on net dividend income. So there is no major difference on the amount of deduction available between 80M and 115O. Subsidiaries. If read carefully, 115O was specifically available to subsidiaries, whereas 80M, dividends received by a domestic company from any other domestic company which may or may not be a subsidiary. So under 80M, the condition is that it should be a domestic company and need not be a subsidiary for us or for the companies to avail the benefit. Next point of consideration would be gross total income. Being Chapter 6A deduction, 80M is available or will not be available or will be restricted in the scenarios where the gross total income is negative or insufficient, even though such company may have distributed sufficient dividends to its shareholders. In other words, any company which has paid the dividends. Any amount of deduction under this chapter is available only when the gross total income is positive. Next would be domestic versus foreign subsidiaries. As mentioned earlier, Section 115O is available to subsidiaries. Therefore, it applies to both foreign subsidiaries and the domestic subsidiaries, whereas ATM is available only to the domestic companies. Therefore, subsidiaries which are domestic companies can only be applied for this benefit. This provision was inserted consequent to the removal of DDT. This was earlier in Act, but once the DDT was in effect in 2003, during that DDT regime, a similar benefit was made available to the companies under Section 115O, whereby certain dividends received by the domestic company were allowed to be reduced for determining the net amount on which DDT is to be paid by the company. So, the conditions for availing deduction under ATM, where gross total income of such company in any previous year includes income by way of dividends from any other domestic company. Quantification of deduction. It can be either lower of dividends received from any other domestic company or dividend distributed by the RSSE company on or before the due date. Here, the due date signifies that the 1 month before the due date on which filing of returns are to be done under Section 139(1). Now, considering issues with the DDT initially, companies were paying higher rate of tax for the amount distributed or the distributed income portion. That is, generally, the companies will be taxed at 25 or 30% respectively. Along with the amount of income tax being paid, a DDT of 20.56 was paid by the companies on the amount of distributed income. This was an extra burden to the companies. The second point shall be no credit for tax paid. That is, DDT was never treated as a tax paid on behalf of the shareholders in case of foreign investors. So, in Indian scenario, for the Indian investors, any DDT paid for any income on which DDT paid shall be exempt in the hands of the investors. But in case of foreign investors, that was not the scenario. Indian investors. So these were the issues with the DDT. Now, having abolished the DDT, still there is issue for the Indian investors, as the amount for the Indian investors who earn above 50 lakhs, still they end up paying a higher rate of tax. One, because of the surcharge that is being charged, which ranges from 10% to 37%. So let's see who are the gainers and who has ended up paying more in respect of the DDT or the dividend income after abolition of DDT. One, let's go with the gainers first. Retail investors with total income of up to 50 lakhs. Since they were paying at a higher amount or higher rate of 20.56%, now it's enough if they pay within their own slab rates, which will be much lesser as opposed to the flat rate of 20.56%. When confirmed with numbers, pre-budget and post-budget, this works out with any amount between the taxable basic amount of taxable amount and up to 50 lakhs. It's always higher when the DDT was available. With abolition of DDT, people are actually paying much lesser than what was being paid, including their own tax plus the DDT which was paid by the company. The second category shall be domestic mutual fund or asset managers. These people enjoy a pass-through status and pay no tax. as they now they can pocket large dividend income from their portfolios, as they will no longer suffer indirect incidents of DDT. Uh, at uh, at the face value, like even if dividend income was mutual from mutual fund was exempt in the hands of shareholders, mutual fund managers distribute dividend income on the balance remaining after the DDT is being paid by the company to such mutual funds. In general, it is advisable for the people to shift from dividend plan to growth plan after this change. Third category would be foreign investors, which is corporates. Corporates now can pay tax, that is foreign corporates can now pay dividends earned in India at either 20% or lower rates specified in the DTAs, that is their home country's tax treaties with that of India. These rates for few countries are as low as 5% in some cases. Fourth category shall be multinational and foreign companies that receive dividends from their Indian subsidiaries, which will enjoy the same or similar regime as the foreign investor corporates. People who will be losing money or who will end up paying more tax than DDT when DDT was in effect shall be those individuals who has income more than 50 lakhs a year. For example, if a person earns so much of income, the total income of this person sums up to nearly 71 lakh 50,000, where previously up to 10 lakhs his dividend was actually exempt. Now that his income is taxed, previously he'll be paying a total tax including DDT of 21.62 lakhs, whereas now with DDT being removed, his entire tax will be subject to, his entire dividend will be subject to tax, and the total amount of tax he'll have to pay will be near to 22.39 lakhs. And with numbers, the difference of the tax paid before and after DDT removal will keep on increasing with the increase in the amount of income above 50 lakhs. Second category of people who will be paying more tax shall be big name promoters of Indian incorporation. Generally, these people will have, in general, an amount of income which is more than 5 crores, where surcharge of 37% shall be applicable. So this will they'll end up paying a huge amount of tax as opposed to the flat rate of 20.56 amount which was paid by the company itself as DDT. In conclusion, the various laws amended or inserted in this regard, when read together, will have the following effect. The incidence of taxation of dividend income has shifted from the payer of dividend to the recipient of dividend. The scope of double taxation of dividend income has been reduced. DDT was levied at a flat rate using the concept of grossing up without any regard to the individual marginal rates of tax. Now, the dividend income will be charged at the maximum or the marginal rate or the slab rates of such individual or the recipient of the dividend. Thank you for your time.